If you're new to Forex and you're tired of all the confusing jargons, figures, and complicated strategies, this is the only video you need to watch. This is a complete beginner-friendly Forex course and it is 100% free. I have structured it so that even if you have never listed a trade before, you'll live with the confidence to open your first Forex account, understand how the market works, and avoid the common mistakes that wipe out most beginners. I'll show you the same roadmap I've used to train my students, people from Nigeria, Ghana, Kenya, Uganda, South Africa, and even the UK, US, and Canada, and help them start their trading journey with the right foundation. And by the end of this video, you not only understand Forex, you'll be ahead of 90% of people who have tried and failed. Now, my journey into trading started with crypto trading in 2019, and just like most beginners, I've lost all my money a few times. I watched all the free YouTube video then, joined multiple mentorship, and tried every strategy under the sun until I finally crafted out a strategy that made me become profitable. But here is the thing. I did not start Forex trading until January of 2025. And when I did, I was stunned. The same strategy I was using in crypto, they worked even better in Forex. The market was more stable and more predictable. And I literally asked myself, why didn't I start trading Forex earlier? Now, that is why I am making this video. So if you are just getting started or still struggling, this video is your shortcut. This is the beginner-friendly roadmap I wish I had in 2019 when I started, and it is tailored for this year. So you can skip the pain and start with clarity. You just have to eliminate every distraction now and pay attention. Let's begin with the first question. What is Forex and how does it work? Forex simply means foreign exchange, or the process of exchanging one currency for another. But when people say Forex trading, they are talking about something more specific, which is speculating on the price movement of currency. Just like you might buy Bitcoin and hope it goes up, in Forex, you might buy Euro USD hoping that Euro will gain strength over the dollar. Now, let me break this down with something more relatable. In Nigeria here, if you want to buy or sell the dollar, you have to go to the Bureau de Change or meet your aboki in the streets and exchange your naira for dollar. Let's say the aboki is selling $1 for 1,500 naira and you buy at the streets. Later the rate rises to 1,600 naira and you go back to him and sell that same $1. You have made 100 naira profits. That is Forex trading on a small scale. But in online Forex, we do this digitally on a much bigger scale with different currencies from around the world. Now, here is a mind-blowing fact. The Forex market is the largest financial market in the world. Over $7 trillion is traded every single day. I'll say it again. Over $7 trillion is traded every single day. That is more than the stock market, the crypto market, and gold combined. And the question is, who is trading all this money? It is not just you and I. Forex is traded by banks, governments, hedge funds, and corporations. They actually make up 94.5% of Forex traders. And the retail traders, you and I, just account for about 5.5% of the traders. Now, unlike stocks, Forex is open 24 hours a day, 5 days a week, Mondays through Friday. That means you can trade anytime from anywhere you are. The next question is, how do people actually make money in Forex? It is simple. You are either buying a currency pair, expecting the first currency to rise in value, or you are selling it, expecting it to drop in value. For example, if you buy Euro USD, you're actually betting the Euro will rise against the value. If it does, and you close the trading profits, you make money. The size of the profits depends on your lot size, pip movement, and leverage, which I will explain shortly. But for now, just understand this. Professional Forex trading is not about physically changing money like at the aboki or at your bank. Instead, it is simply predicting whether one currency will rise or fall in value compared to another. If you're right, you make money. If you're wrong, you lose money. That is it. You're not buying actual dollar or euro. You are trading their price movement on a chart using your broker platform. The goal is simple: buy low, sell high, or sell high, buy low. And that is what we're going to learn today. Just stay with me. It is simple. Now, before we start placing trades, let's break down these few key terms that every Forex trader must understand. Again, don't worry, I'll keep it simple. The first one is currency pair. In Forex, you're always trading one currency against another. That is called a currency pair. For example, you have Euro USD, that is Euro versus the US dollar. The first currency is called the base currency, and the second one is called the quote currency. So if Euro USD is 1.10, that means that 1 euro is equal to $1.10. When you buy this pair, you are expecting euro to go up in price. When you sell, you're expecting euro to go down in price. Currency pairs are grouped into three categories. First is the majors. These are the most traded pairs in the Forex market. They are made up of currencies from the world top 7 economies, always paired with the US dollar. They include Euro USD, which is the euro versus the US dollar, USD, which is Great British pounds versus the US dollar. Then you have the dollar paired against Japanese yen, Swiss franc, Australian dollars, Canadian dollar, and the New Zealand dollar. Note that the currency pair notation is standardized. For example, it is always USD JPY and never JPY USD. And the highest liquidity, the spread is tight, they have low slippage, and they are most beginner friendly. Major pairs account for 70 to 75% of the total Forex volume. The next one is the minor or the crosses. They are the major currencies paired with each other, excluding the US dollars. So you have Euro JPY, GBP USD, Euro UAD, and so on and so forth. The exotic pairs combine a major currency with a currency from a developing country or a small economy. Example is the Euro ZAR, which is US dollar versus the South African rand. They also have the Euro versus the Nigerian Naira. These are the exotic pairs. They make up less than 10% of the total Forex volume. And as a beginner, avoid them because they have low liquidity, high spread and slippage, and price can spike unexpectedly. PIP is another term every Forex trader must know. It stands for percentage in profit and is the smallest price movement in most Forex pairs. Think of it as a point that helps you measure how far the market moved. For most currency pairs, 1 pip is equal to 0.0001. It's a 4 decimal place. So if Euro USD moves from 1.1000 to 1.10005, that is a 5 pip movement. For JPY pairs like USD JPY, pip are measured with 2 decimal places instead. So if USD JPY moves from 135.20 to 135.40, it is a 20 pip movement. Pips help you measure how much money you are gaining or losing in a trade. The more pips price moves in your favor, the more profit you make. How much each pip is worth depends on your trade size, also called lot size, which I will explain next. A lot is simply how much you are trading. There are 3 main lot sizes. Standard lot, which is 100,000 units. For Euro USD, it is $100,000. Mini lot is 10,000 units, and micro lot is 1,000 units. Now you might ask, does it mean I need at least $1,000 to trade Forex? No. That is where leverage comes in. Leverage allows you to trade with more money than you actually have. For example, with 1:500 leverage, which is what most brokers give, a $100 account can control $50,000 worth of currency. That is $100 times 500. Now, this is good, right? Yes, but leverage is a double-edged sword. It can multiply your profits. It can also multiply your losses if you don't know what you are doing. It is the key to blowing your account. So before you place your first trade, you must know risk management. It is the key to using leverage to your favor, and we're going to get to that soon. Now, to be able to open multiple trades with your leverage, you need what is called margin. Margin is the amount of money your broker locks up when you open a trade. Think of it like a security deposit that gives you access to a large trade size. For example, if you're using 1:500 leverage and want to open a $50,000 position, your broker may require only $100 as margin. As long as you have $100 in your account, you're allowed to open that trade. Let's say you go long on Euro USD with a 0.5 lot, which is the maximum position size you can open with $100 at 500x leverage. That means that each pip movement is $5. So if the trade moves 20 pips in your favor, you make $100 profits. But if the market moves 20 pips against you, you lose $100. That is you lose $100. Your full margin. At this point, your broker will likely issue what is called a margin call, or automatically close your account to prevent further losses. Why? Because you can't lose more than your margin. That is exactly why risk management is critical, and we'll get to that in detail very soon. The next thing you need to know is spread. Now, every time you look at a forex pair like Euro USD, you will see two prices: the bid price, which is the price you can sell at, and the ask price, which is the price you can buy at. The first price is the bid, which is the price the broker is going to pay you if you are selling. And second price is the ask. This is the price you pay to your broker if you are buying. The difference between them is called spread. In this case, it is 2 pips. That 2 pip gap is the broker's profit, because the broker executes your trade order at the bid or the ask price and passes it to the market at the ask or bid price, respectively, making an instant 2 pip profits, as in the example we talked about earlier. This is why when you enter a trade, you notice you start slightly in loss. This is because the spread is already deducted. So if I enter this trade with a 0.5 lot, I will instantly be in $10 loss, since each pip movement is $5 in this case. The next thing you must know is order types. This is the way you enter a trade. In Forex, there are 2 main types of orders. You have the market order and you have the pending order. A market order is when you enter a trade immediately at the current price. Example, let's say Euro USD is at 1.1050 and once you buy it immediately, then you hit buy. Your trade is placed instantly at that price. Market order is best for fast entries, breakouts, or reacting to market news. For pending orders, it is when you want to enter the market only if price reaches a certain level. There are 4 types of pending orders. You have the buy limits. This is buy at a price lower than the current market price because you believe that price is going to come down, pick your order and go up. They have their sell limits, which is sell at a higher price than the market price because you believe that price is going to go up, pick your price and come down. You also have buy stop. Buy stop is a buy at a price higher than the market price because you believe that price is going to break out of a resistance, pick your order and keep on going up. Then sell stop, which is sell at a lower price than the market price because you believe that price is going to break out of a resistance, pick your order and keep on going down. Now, to round off this section, there is one more group of terms you need to be familiar with, which is bull, bear, buy, sell, long and short. When someone says the market is bullish, it means price is going up or expected to rise. A bull market is when buyers are in control and price are tending upwards. Example, if I say I'm bullish on Euro USD, it means I think Euro USD is going up. The opposite term is bearish, meaning price is expected to go down. A buy market is when sellers are dominating the market. When you buy a currency pair, you are opening a long position expecting the base currency to increase in value. Example, when you buy Euro USD, it means you expect Euro to rise against the dollar. So when you hear I am going long, it simply means I am buying. The opposite is selling, also called going short. This is when you expect the base currency to drop in value. Now, I know this might feel like a lot, but don't stress. You are not expected to master these terms instantly. The more you trade and practice, the more natural this becomes. That said, let's move on to actual tools you need to start trading and how to set them up step by step. To start a successful trading journey, you need these tools. The first tool is a Forex broker. This is the platform that gives you access to the market. Without a broker, you can't place trades. Think of your broker as the bridge between you and the Forex, the $7 trillion Forex market. There are many good brokers out there, but the one I'll recommend, I'll leave the link in the description of this video. It is Edgewonk Traders. When you choose a broker, look for one that is regulated, have low spread, fast execution, easy deposits and withdrawal method, and responsive customer support. Edgewonk Trader has all of this, and the link I gave in the description ensures that the account type you're going to choose is the ECN account, which is the account with the lowest spread possible. Edgewonk Trader also provides you with a demo account. A demo account lets you trade with virtual money in a live market, so you can test trading to know if it's actually for you before committing your real money to trade. Now, once you've picked a broker, you need to download a trading platform. The most common ones are MT4, which is MetaTrader 4, and MT5. These platforms allow you to analyze charts, open and close trades, set stop loss and take profits, use custom indicators, and even automate trades using what is called expert advisors, which are bots that trade for you based on a strategy. Now, even though MT4 and MT5 have inbuilt charts, they simply can't compare to what TradingView offers when it comes to technical analysis. TradingView is more flexible, more beginner friendly, and packed with powerful tools for charting and strategy development. I use TradingView for all my charting. With TradingView, you get cleaner visual, easy to use drawing tools, access to multiple time frame, and a wide range of indicators. You can visit tradingview.com directly or use the link I have in the description of this video to sign up. After TradingView, the next thing you need is a calculator. I cannot overemphasize how important this tool is for risk management. If you are not using a position size calculator, you are one step away from blowing your account. The one I recommend is called the FS Crypto Calculator. It helps you to easily calculate the exact lot size to use based on your account balance, risk percentage, and stop loss. Everything I've talked about so far, your lot size, leverage, margin, pip value, this calculator does it all for you in a few seconds. That way, you know exactly how much you are risking and how much you stand to make before you even place a trade. It works for Forex, crypto, and indices, and it's available on both iOS and Android. Just search for FS Crypto Calculator in your app store or use the link in the description to get it. And lastly, the tool you need to become successful in trading is a community. If you want to stay informed and connected, join a quality trading community. Most communities, including mine, use Telegram to share signals, trade breakdown, mentorship, and market updates. I will show you how to join mine at the end of this video, so stick around for that. Now, let me quickly show you how all these two connect so you see the full picture. You will start by creating an account with your broker. This is where you make deposit and withdrawal and also set your leverage. Once your account is ready, you connect it to a trading platform like the MT4, MT5. That is where you actually place your trades. But before you take any trade, you need a solid plan. That is where TradingView comes in. Use it to analyze charts, find setups, draw levels, and prepare your entries. After your analysis, you calculate your lot size and risks using the FX crypto calculator based on your account balance, stop loss, and risk percentage. Then you take that value and place your trade manually inside the MT4 or MT5 using the correct lot size and stop losses. And if you are a part of a trading community, you can also get trade ideas, signals, and market updates or support analysis. Again, brokers hold your phone and gives you market access. TradingView helps you to analyze your plan. FX crypto calculator calculates your lot size and risk. MT4, MT5 is where you execute your trades, and Telegram keeps you connected with a learning and signal community. That is a complete system. Simple, powerful, and beginner friendly. Now, using the link in the description, I'm going to create an account with EscoTrader. For this video, I'm going to choose the demo account with MT4. Make sure the platform is MT4 ECN. Click on Not a Robot and then sign up. So I'll go to my email to check for a message from Esco. Now, if you don't see it in your inbox, just go to your spam folder. Sometimes it just appears there. So Esco has sent me my password and login, which I can change later. So I can now use this to enter. So here you can see that I have a total balance of $10,000. This is demo account. Of course, this is virtual money for me to trade with. And the next thing I can do is I can see my leverage here and every information I have here. The next thing I should do is to complete KYC. To do this, all I need is one valid government issue ID, just like your national ID card, international passport, or driver's license. KYC is compulsory on EscoTrader, but you don't need to complete KYC immediately. You can still explore the platform, practice demo trading first before coming here to complete KYC. And when you create an account, EscoTrader might call you to help you set up your account properly. Now I have an account with EscoTrader. The next thing I do is to go ahead and download MT4 from my app store. I'm not going to use MT5 because EscoTrader only supports MT4. And this is because MT4 offers traders a lot of. MT4 is the best, is the first. It offers a lot of bots that helps traders even automate their trade. So I already have MT4 downloaded. I'm going to go ahead and open it. So what I'm going to do is to go to the settings and click on get started. If you already have an account like me here, what you will see is new account. I'm going to click on the new account and I'm going to click on login to an existing account. Then I will now go back to my email. You see that the email that EscoTrader sent me earlier has two passwords. The first one is the password for my account, and this one is for my trading platform. So you can see the login, the password, and the server name. So the server name is this RSG Finance Demo. I'm going to search here RSG Finance Demo. So I'll click on it, then I'll enter the login and the password they gave me, which is the second one. Once that is done, I'll click sign in. Now I have my account here. So we're on MT4. So let me give you a quick tour on how to navigate MT4. So under trades here, you will see your account balance $10,000. Again, this is demo account. And I'm going to explain the free margin and everything later. And if you go to history, history is where I see the history of the trades I've taken. Under quote, you see this is where different currencies are displayed. I like it to be in advance because it shows me a lot of things, my PEEP, my spread, and so many other things. To add currency pair, I'm going to click on this plus that is here and just search for that currency pair. For example, Euro USD. And note that the currency pairs for Esco has EX ending it. So I'm going to tap on this plus here to add it to this major place. So when I tap on it, it's going to disappear and come to this place. So you can see Euro USD EX and it is highlighted. All these other ones I cannot trade them because they are not in EscoTraders. So what I can do is to click this pencil icon and actually mark all these other ones and delete them. It's as simple as that. And I can add more currency, for example USD JPY. I just make sure that it ends with EX, and I click on the plus to have it in this particular section. When I tap on this pencil icon, I can also reorder my currency pair. So what I'll do is I'll just add all the currency pair I trade here, and that is it. Okay, now to place a trade, I'm going to tap on the trade. I want to take like Euro USD, for example. I'm going to tap on it and click on trade. When you have market execution, if I click on it, it shows me all the order type. I can select the particular order type that I want. We'll leave it on market execution. So where you have 0.03 is where I enter my lot size, which I'm going to get from my FS Crypto calculator. This will enter my stop loss and my take profit, which I'm going to deduce from the technical analysis that I've done or the signal I received. Once I have entered all this, then I'll type either sell market or buy market. So this is simply how you place a trade. And now that we have learned this, then next skill is how to determine the direction the market is going and how to manage risk. As a beginner, your goal is to aim to be right 50% of the time with a minimum risk reward ratio of 1:2. That means when you win double of what you lose when you lose. Let me break this down. If I risked $100 per trade and I take 10 trades with a risk reward of 2 hours, it means that I win 5 trades, which is 5 times 2 times 100, $1,000. And my 5 losses is 5 times 1 times 100, which is $500. Therefore, my net profit is $500. So even if I am only right 50% of the time, I still make profits. Note that no trader wins 100% of the time. As a matter of fact, the best traders only win about 60% of the time, risking 1 to 5% of their account size. So the best traders don't try to be right 100% of the time. They need only right 50% of the time. What they aim to do is to increase their risk reward to like 3 or 4, so that when they are right, they win like 4 or 3 times more than when they are wrong. Now the question is, how do you forecast the market? How do you determine the direction the market is going to go? There are 2 ways to do this. You have fundamental analysis and technical analysis. In fundamental analysis, we are focusing on economic news, interest rates, political events, and so on. For example, if the US raises interest rates, the dollar often gets stronger. So these traders want to long the dollar. Traders who trade this approach pay attention to news like NFP, CPI, or central bank updates. Technical analysis is what most traders use. In technical analysis, we analyze price charts and use tools like support and resistance, trend lines, candlestick patterns, Fibonacci level, and indicators like stochastic RSI. The idea is this: price reflects all known information. If you study what it has done in the past, you can often tell where it's likely to go next. Some traders use both of them together, which is also fine. But in this video, we are sticking with technical analysis using TradingView. Okay, so this is TradingView. On the axis, we have price, and on the x-axis is time. Drawing tools are on the left menu, and at the top, we have the currency pair. If I click on it, I can change the currency pair to whatever I want, like USD KPY. Next to that, we have the time frame. So time frame are from 1 minute up to even 12 months. We are currently on the 4-hour time frame, which means that each of these candles you see here represent what happened in 4 hours. If I click on 1 hour, it then means that each candle represents what happened in 1 hour. This particular candle starts at 4 p.m. and ended at 5 p.m. It opened at 2 p.m. The price of 144.028, then went as high as 144.038 and came all the way down and went as low as 143.735, and at the end of that time frame it closed at 143.762. So a candlestick is defined by the open, high, low, and close. Since the price at the close of the candle is lower than the price at the opening of the candle, it is a bearish candle. The color is usually red, but mine is black because I've done customization to this chart. If you want to watch that video, I'll leave it in the description of this video. If it is a bullish candle and the color is usually green, like in these ones, or the green ones, their closing price is higher than their opening price. Now beside candlesticks, we have other types of charts. We have the bar chart, the line chart, the high Kanashi candlestick pattern, but what we stick with is a candlestick because they give us more information. Now to add an indicator, we're going to come and click on where it says indicator. Then I'm going to search for the stochastic RSI and click on it. You can see this indicator is added to the bottom of my chart. I use this indicator for confirmation, and I'm going to get to that. To forecast where price is going, we first need to understand market structure. Price can only move in three ways. It's either trending up, trending down, or moving sideways, which is called the ranging market. Now, when price is trending up, it makes what we call higher highs and higher lows. So this is a high, then the market dropped down to this low, and then price moved up again to another high. This high is higher than this high. That's why we'll call it higher high. Now this is a low, and when the market dropped, it made another low. This is a low to this high, but this low is higher than this low. So we'll call this a higher low. So the market makes higher highs and higher lows in an uptrending market. Another thing we'll notice is that when the market makes this move high, it broke structure. See what I mean? This is the previous high, and the market went above this previous high. So we call this a break of structure. And the move that made this break of structure is called the impulsive move. And the pullback that didn't lead to any break of structure is called the retracement move. So the market is always breaking structure to the upside in a trending market. The opposite is the case for a downtrending market. The market in this case is making higher lows and lower highs, and we are having an impulsive move to the downside, and the market is also breaking structure to the downside. This is what characterizes a downtrending market. For a ranging market, the market is moving sideways, making equal highs and equal lows, relatively equal highs and equal lows. So this is a ranging market. And for an uptrending market, we want to see a break of structure to the upside. And for a downtrending market, we want to see a break of structure to the downside. Now, once there's a break of structure, we are now interested in the retracement move. The retracement move is where we want to enter our trade. Again, this retracement move is where we want to enter our trade. But we don't just take any retracement move. We want a retracement move that aligns with our Fibonacci level. So I'm going to come here again and pick this to call the Fib level. Then, once there's a break of structure to the downside, I'll place the Fibonacci at this low and draw it up all the way to this high and extend it to the left. What I'm interested is in this 6-2 It's actually 618, but I approximated to 62. What I'm interested is in if the retracement move touches or go below the 62, I am interested in to enter this trade after a confirmation. And the way I get this confirmation is with the stochastic RSI. So for the stochastic RSI, once the retracement move reaches the 618 level and this blue line called the K line start moving up and crosses into the 20 level, then I'm going to take that trade. And the way I take that trade is, first, I'm going to pull out my risk reward ratio tool, which is this for an uptrending market, which is a long tool. I want to enter the market here. I can place my retracement at the swing level either here, or if there's another swing level here, I'll put it here and take my profits at this level or at this level. I just have to make sure that I'm aiming for at least a risk reward ratio of 2. Then I'll then go ahead and pull out the position size calculator. For example, for this particular trade, the entry is 149.846. The stop loss is 149.255, and my take profit is 151.228. Now let's do this in the chart proper. So this is Euro USD. I'm going to start from the 4 hours. Mind you, this works across all time frame. So again, here I'm looking for a break or structure. So if you look at this particular one, so this is the last swing above here. Now, as you get experience, you can actually know that we can consider this here because of this gap as a breakout structure. Now, once this happened, we've seen a breakout structure. Then what do? We pull our Fibonacci and draw it from the bottom here up to this high and extend it and see what happened. We have price come down to this particular point. Okay, now this doesn't come down for us to take the trade, but if I go to the 1 hour, which is where I like to take my trade, you will see that at this particular point, this came down, climbed up, and gave us a very good entry. I like to actually go down to the 1 hour time frame before I take my trade. Now let's look at the next one. So for the next one, we can see here that if you look at this, price broke this structure here, and if you put the Fibonacci from the bottom to the high, it didn't come down to 62. It means that we are not going to take this trade. If you look at this again from here, price broke this structure. Now that is a structure, it broke the structure. What do? We take our Fibonacci from the bottom, take it all the way high, and this gave us a perfect entry. You can see as price touches this, it gave us entry. So if I pick my risk reward ratio tool and I enter this here, putting my stop loss at the last swing, you can see at here I'm having a risk reward ratio of 2.23. Now the more as you get experience and you understand other blocks, you can even place it here to even get a tighter risk reward ratio. Now if you look at this particular one, you can see price came down here and it gave us a signal, but this is a wrong signal. Again, just like I said, we only aim to win at least 50% of the time when trading. But the more you get experience, the more you know the nuances to this. If I go say back to the 4 hour time frame, you can also clearly see that on the 4 hour time frame, if I take this from this particular point, which is the last swing, if I take the whole of this movement as break of structure to this particular structure here, or even this one here on the higher time frame, and I pull my Fibonacci from here to all the way up to this particular point, you can see this is also respected because when price got here, there's a movement upward. These are the things you learn as you get experience with this. Let's look at another one. So we have this structure here. This structure is broken, and we'll pick our Fibonacci from the last swing before it, and all the way to the high. And you can see that if we entered here, when this market enters, we will still be in profit. If we entered here, we are still going to be in profit. But if I scale down to the 1 hour time frame on this particular level, this is our first entry. Our stop loss is here, so we are protected. If we do the same thing at this particular point, you can see what there's a breakout structure here to the upside. And if you go from here, this swing all the way high, we still got a very good entry at this point, and we also got a good entry at this particular point, giving us even a much higher risk reward ratio. So this is simply how we trade. This also works for when the market is breaking structure to the downside. So if you look at this particular one, this is break or structure to this side, and what do? We pick our fib to. In this case, we are interested in the market to the downside, so this will have been a good entry, and the stochastic RSI to also confirm our entry at this point. If you look at the next one, breakout structure to the downside, what happened? We'll put our Fibonacci 2 from up here, then to this particular level, and extend it all this way. This is also a very good entry, and we'll have made profit to this side. Again, if you look at the next one, structure was broken here, and we can draw our 2 from the top to the bottom, which is this. And once we enter the 6-2 level, we'll look at the stochastic RSI. It gave us an entry here, and what do we do? We take this trade. And so this is pretty simple. Now let me show you, before you take this trade, you have to know how to use the risk reward calculator. So for the last one, which is the one happening as I'm doing this, so we'll have a breakout structure, even though it's really small. So the downside, we'll still do the same thing. We draw our Fibonacci level from here down this way. You can see that we cannot take this trade because this hasn't gotten to our 6-2 level. But let me just go ahead and draw a risk reward ratio 2, so I can place trade, and you know how to use the risk reward ratio calculator. So I'm going to click on the short position, and let's say we're entering here, and our stop loss, we are putting it around here. Of course, we determine this when the market gets to this particular level, and we are targeting this point. This is a risk reward ratio of 3.89. So to calculate the risk, I'm going to open the FS crypto calculator and click on Forex PS calculator. Then here I'll choose the instrument, which is Euro USD, and my account balance is $10,000. That's what I have in the demo account. And risk, let's say I'm risking 1% of my account size. It means that I'm risking $100 per trade. Now the entry price is 1.17355, and my stop loss price is 1.1755. That is all. I'll go ahead and click on calculate. When I click on calculate, you can see that my standard lot size that I'm being showed here is 0.51. So this is what I'll go to my MT4 to place. So for Euro USD, the lot size I'm going to use is 0.51, and in this case I'm actually doing a sell limit. So I'll enter the price here. The entry price is 1.7355. My stop loss price is 1.7550, and my take profit price is 1.6596. Now go ahead and place this trade. This trade will be pending until the market gets here, and the trade will be entered. Now from this calculation, what it simply means that if this trade goes against me, my risk is $100. It means that I am going to lose $100 and nothing more than $100 if this trade goes against me. And if this trade goes my way, you can see the risk reward is 3.89. It means that I'm going to make 100 times 3.89, which is $389 if the trade goes my way. That is what we use the position size calculator for. Now let's say I enter this trade live. For example, I enter this trade live, and I'm using market execution to enter this trade, and I'm selling this market. You can see that this trade is on. To close this trade immediately at any time, I'm going to click on hold it, and I'll click on close. Click on close, and that is it. For this particular one, to close the same thing, click, and I can delete because it's not open yet, or I can modify to change the parameters here and click on modify to have it stick. In this trade section, my balance is simply my account balance. It won't change until I close a part of my trade. Equity is the live balance. It's my balance plus my profit and loss The margin is how much my broker locked for this particular trade. The free margin is how much how much is still available for me to make more trades. And the margin level is the health of my accounts. The margin level should not be less than 100%. It is 0.00 here because I'm not in any live trade here. If my margin level drops below 100 level, it means that my account is in trouble. It means I'm about to blow my account. But if you use proper risk management, like I explained, this will never be the case. So this is it. You've just seen how to read the chart, identify trend, use structure and retracement, confirm with indicator, calculate lot size, place a real trade, and manage it properly. That is a full beginner workflow. All you have to do now is to keep refining your strategy by making sure you are subscribed to this channel to see more videos where I refine this particular strategy. And the step to gain access to my community for signal support and more is in the description of this video. Now, remember that risk management is 60% of your trading success. That is why I made this next video.